Okay, welcome everyone. We'll start our second lesson. Today lesson will go through LO2, which is a learning outcome to be able to analyze financial data for an organization in order to inform strategic decision making purposes. So my name is Anjum Satar and my email address anjum@ukiversity.co.uk. Please, if you have any question, just drop me email on my email address. So before starting today's lesson, first of all, we recap what we learned during our previous lesson, and we'll start. So last lesson we learned about understand the importance of financial data in formulating, delivering business strategy. So we discuss about strategies mean the action plan, why strategy is important in business. So all this we discussed during our last lesson. So we discuss about strategy and planning. So we evaluate the sources of financial data. We discuss about needs, assess the needs for the financial data, and analyze the risk, those are and involved in the decision making. And we discuss risk is the probability of happening something. And we discuss about creative accounting, what is meant by and what is creative accounting. Today lesson will go through our LO2. LO2 is learning outcome to be able to analyze the financial data for an organization in order to inform the strategic decision making process. Interpret the financial statements, which we'll discuss. Conduct the comparative analysis. Look around 2.1, make the recommendation and assess the limitation and recommend, the justification. So all this will be focused in today's lesson. So we'll start, please. So today's lesson will go through our LO2. So we have a inductive content, what we're supposed to be. We can look around the purpose of the provide the information to stakeholders. Stakeholders mean that anybody who have any interest in the business is called stakeholders, like customer, supplier. These are all the stakeholders. They need information to make the various sort of decision. Like investor want to be either they want to invest more, and what company profit earn, what the company is earning per shares. All these sort of information is required to our stakeholder, which is they are interested party. Internal management, they use, the management account versus the financial accounts, which we discussed, last lesson as well. I mentioned you, but we can look around comparative analysis between 2 years. We can compare, and we'll discuss, the ratios, benchmark, industry benchmark, what is meant by these are. So 2.1, interpret the financial statements to assess the viability of an organization. So financial statement on their own are the limited use. So there is a limited use if you can't really interpret the information, and you need information is a lifeblood for any business. So in business can make the viable decision based on the financial information. So we need to make sure the information contain or consist of within a financial statement should, be consistent, should provide the logic, not creative accounting, like, you put more expenses and less income, and you show less profit, or you show more profit, or you underestimate your asset and liability. So that's we discussed in the previous lesson, creative accounting. So today lesson will be focused more about how we can interpret and we can use and different decision we can make it. Does it suggest the business is success? Is it might not for the previous year they made? Think about before coronavirus, COVID-19, and now. What are the key differences we have? So is the key difference we have. So look around, huge things is being changed. So it is important that the user of the financial statement interpret the financial statement to be able to draw a valid conclusion. Involve the use of the comparison previous year. So always good to be, you have 2 years figures, you can see what happened last year, this year, which we'll go through in few minutes. We'll look at a few companies' financial statement. So when interpreting the financial statement, it's important ascertain that who are the user of the financial, like we discussed, management, supplier, these are all the stakeholders. So you need to be look around. They interpret according to their own perspective. Think about bank want to be make sure that any money they will lend to anyone, they will get the money back. So that's why it's crucial for them. So you need to look around the user and what sort of expectation they have and what sort of a decision they can make it. Okay. So Ratio is the simple calculation based upon the interaction in the set of accounts. And for example, changes in the cost of the sale are directly linked to the changes in the sale activity. So changes in the sale activity who have the effect of wages, salary, receivable, inventory. So all this we need to be well aware of, and the ratios of the limited use there its own. The following points serve the useful checklist if you need to analyze the data and you need to make the decision effectively. So need to be make sure our decision should be effective, and that will help to properly interpret. So which will go through the further slides. Okay, anybody any question please? Okay, if you're listening this, you can send me question or ask me via email as well. So ratios, we can look around, we can categorize these ratios. I'll make slide bigger, you can see everyone properly. So a current ratio is called liquidity ratios as well. How liquid our asset is. So we current ratios is current asset divided by current liability. Current asset means the short term assets, short term are obligation. So that's the less than a year. Quick ratio is the most liquid because sometimes inventory is less liquid. You have a stock million, but those stocks, think about the Windows 98 CDs you have in warehouse, and you're thinking, oh, you're a very rich company because you own so much asset. But actually, the Windows 98 CDs may be not worth it to, or people not looking to because it's outdated. So that's why it's not. So that's why we need to take out the inventory figures. Current asset minus inventory divided by current liability. Current liability is the short-term obligation which we have to pay within a year. And the interest cover ratios, profit from operation divided by finance cost times by how many times. So that's we need to be look around. Gearing ratio, what is a gearing if you're high gear? Like think about if you drive a car in a high gear is a high risk. So high gear is a high risk. So we need to be make sure we properly follow. So that's we need to make sure, and then we look around the gearing, non-current liability divided by total equity plus. So this is called gearing ratio. There are the two ratios, the interest cover ratio and the gearing ratio, and especially lenders are very interested in these two ratios. Okay, then we're looking the profitability ratio and use of resources. So what's come under profitability? Return on capital employed. Profit from operation divided by total equity is mean your capital investment in the business and the non-current liability, how much you owe, because that's also you borrow money for the sake of investment in your business. Return on the total asset, how much worth of the total asset or how much return you have. Return on equity, how much is equity mean the share capital. Gross profit divided by the revenue, we can calculate this carry on, and we can compare year by year, that also help to make inventory turnover days, how many times inventory been turnover and converted into finished goods are being sold out, inventory and the cost and the trade receivable in days, holding period, working lifetime, working capital cycle, which is all the crucial ratios to calculate, and different stakeholders use to make different decisions, which we'll look further in slides as well. Ratios. Okay, next we're looking the financial statement. The main objective of statement is to help user to make the economic decision. Economics external, internally we can make the decision. So think about your sale drop, your margin drop, what you do. Maybe you outsource it, cut to. Maybe you have a lot of IT expense or the distribution expense. Why not to hire the courier company that will deliver those stuff, and you pay them lump sum fees, or you pay the every pick and drop. So you can set, that can be a cheaper, but we need to look around in different perspective that decision will make. We need to review the ratios. So we need to look around the benchmark, which will go through further benchmark. Conduct a comparative analysis. So we need to conduct the comparative analysis. Return on capital employed, we can look around, how much and these ratios we can use for comparative. Profitability ratios, how much profit we have divided by tax. We can do the 2 years, we'll see some ratio. Liquidity ratios is mean the most asset, like earlier I explained you in 2.1 as well. Current asset divided by current liability. Quick ratio, current asset minus inventory divided by current, and it shows the all being explained what these shows. So cost of sale divided by, it shows that rapidly business inventory are sold on the average during the time, which is quite good. Working capital cycle is running capital cycle, inventory turnover days plus receivable turnover days minus payable turnover days. So an increase in any of these periods can be sign of liquidity problem. Yes, if is the increase in any these period can be the sign of liquidity problem, because your inventory turnover days increase, your receivable turnover days increase. It means your working capital cycle converted into the cash is reduced. So that's we need to be look around. Uh, as I mentioned, financial position, we can look around that, gearing and interest cover ratio. And now we look, the two companies, which is one of them is Next. And what we can do, we can copy these links, and we'll go through and we'll copy this link, and we can in Google just copy and paste it, and we can look around here. So if we look here, we can look around income statement. We have a consolidated, which is on the page 115. So what we can do, we can even type the page number here. So this is a consolidated comprehensive income you will see there. So we'll say the profit, we can look around because this is further in detailed one, and this is the comprehensive here. So you will see there further we can go to consolidated here. Yes, so that is the consolidated. So I was right there. So we look the last year, this year. Take the difference between two. If we need to use the gross profit margin, so gross profit here divided by the revenue times by 100. So we can look around this year and we can look around the last year, and you can compare both. Operating profit, so operating profit divided by revenue times by 100, we can find last year, this year, and we can compare. You will see here one of the comparative analysis, earning per share. So like last year was 435 pence per share, and this year and the last year was 416. So you will see there is an increase around uh, around 18 pence is an increase there in the earning per share. Yes, so which is good. Earning per share 18 pence has been increased, improved, and we can compare with other, the competitors as well. So what we can do, if you can just type financial ratios of next 2019 and 2018. Yes, you can find through Google Scholar. You will see that there are a lot of companies those are providing the analysis, and we can look around here. You will see there what is happening there last year, this year's ratios, all we've been given here. So you will see the sales. You will see their year by year changes. You will see the next. Yes, EBIT internationally are, and we can look around. Yes, we don't need to. We have so many other websites as well where we can really, you don't need to pay money for these. Yes, so you will see the last year UK operation that was there and how much change we have. So that's we can compare with various other companies. Yes, what press release they have, and if you want further 10 years history you want. Yes, so you will see here what's happening last year 20. Yes, retail, and that's a comparative in many years. So that's the way we can, and you will see there the various companies they do the ratio analysis, and one of this is here. You can look around the last, you can look around their ratios. Yes, debt to equity ratios, you will see there what happened, increase and decrease as a percentage, and you look around all this, and we can make different decision by interpreting these information. So these are comparative analysis is quite good to be used in to make the financial. So here we are looking 2.1 M. You will see there I have two companies, Anika and Papika, These handouts is there on the Moodle as well. You can look around. We are using the formulas. We calculating that was 45, that was 52. You will see there which has it has different. So which one is perform better? So Papika is better than Anika because, and then if you look the operating ratio, then Anika is 9 and the Papika is gearing is Anika is 13, Papika is. So Papika is more risky because the higher gearing is a high risk. So those, if the bank want to make a decision, they are looking closely this before lending. Interest cover ratio that was 11.6 times, that's only 3 points. So this is less risky, that's more risky. So asset test ratio 1.22 and this is point. So this is more risky. Papika and Anika, you can compare all and you can interpret these ratios. Okay. Anybody, any questions? So we done these ratios and then the user and the need of the information. So investor need to help to determine whether to buy, hold or sell the share. Potential investor help to be determined whether to buy the shares or the bonds. Lenders, they look around whether the loans or the interest will be paid. Supplier and the other trade creditors, they look around, determine whether the amount owing to them will be paid, and the customer and the government and the public, they all they're looking, and everyone have a different interest and different expectation. Then we have a 2.m2 is assess the limitation. So these are we're looking the Papika and Anika, and we can look around is ratio seems okay, but we need to look around other factors. Let's look around the performance is good, but no COVID-19 and other environmental factor we need to look around to make the right decision. So limitation of the ratios is not mean, if you have a sales more, it's not indicate you have a cash more, because a lot of companies is being failed due to, and the people use the last lesson we discussed about the creative accounting, and the creative accounting that's, make, so that's, we need to look around. Political, economic, social, and technological pests, what are the problem in, so we need to look around those and we need to monitor closely. Anybody, any question? If you have, please. Okay. 2 2D1 recommend with the justification method and the tool allow. So main limitation, financial maybe swear month out of the date. Financial statement is only include the information which can measure in the monetary term, but we need to look around the intangible, which is the goodwill and various others. Comparison between the business and maybe mislead sometimes the size of the business and various other factors that we need to look around, because and there, if you we can look around, and we can look around the comparative analysis, we can look around the sensitivity analysis, one of them analysis that also help to make the right decision. So for the sake of what I'm going to do, I'm going to look around, if you, the website is called Tutor to You, and we'll say financial ratio quiz, and I'll copy this link. Please make sure you will do one, to clear your understanding. This sort of, the little quiz that will help, to improve our understanding. And I'm going to copy here. And if you want to be further look around financial ratios in terms of to make assignment prospective, I'm going to give you one more. Is useful to look around the financial ratios, and right next to that is Kaplan. So Kaplan is one of the publisher, and there's a lot of discussion about the financial ratios and how these ratios all being summarized into this, the little mind maps, and all being, the ratios being calculated. So that's, we can say is further is useful to be look around the financial ratios and their use and and we can say justification all being in this link. So it's good to be look around. Anybody, any question? If you have any question, anyone, so please drop me email to the lesson. We learn about the financial ratios, we learn about the financial data, we learn about what sort of the decision can we make, and how many types. So we learn about 4 types of ratio: liquidity, um, use of resources, which also known as efficiency ratio, gearing ratio, and we learn about these, the 4 types of ratios. So you can look around. We learn liquidity, financial position, profitability, and use of resources. So these are the 4 types of ratios those we learn, and we can use them to make the decision. We discuss about stakeholder, their expectation. We use the example of Anika and Papika. So, and I copy the link for you to do quick. If you have in the meanwhile any question, please guys, make sure just drop me email, and I'll try my best to get back to you as soon as possible. And I hope so I will speak you all during our next lesson. Have a nice time. Speak you all, and just carry on doing. Please do background reading, and watch this listening. If you just and in the meanwhile, if you have any question, drop me email, and I hope speak you all during next lesson. Thanks for attending. Bye bye.